Continuing with topic 7 of paper 3, which is looking at over-the-counter derivatives trading, reporting and clearing, we now move on to section 3, conduct requirements in relation to OTC derivative transactions. Now, the two previous sets of rules came in 2015-2016 relating to reporting and recording, and then clearing and recording of OTC derivatives. Now we have conduct requirements with regard to OTC derivative transactions, which we never did before, not specifically for these types of transactions. Now, there's not that much in it. We've got an introduction there under paragraph 3.1, which is telling us that there are going to be two new regulated activities, type 11 and type 12. Type 11 dealing in OTC derivatives, or advising, and type 12 providing client clearing services. They've been around for a number of years. They're still not formalized. So while they're in the material, there's no way they're going to be examined currently. But the conduct requirements are split up into two parts. The conduct with regard to mitigating risk, reducing risk with over-the-counter transactions that are not centrally cleared, and managing risk in relation to group affiliates and other connections. So the mitigating risk is where you've not got mandatory clearing. You're still relying on the other counterparty not defaulting. And the second is group affiliates. So paragraph 3.2, mitigating risk in transactions, OTCD transactions, are not centrally cleared. The requirements will be a contracting counterparty to OTCD transaction and licensed for type 9. So these are the two that would be subject to these requirements. Risk mitigation requirements do not apply to registered institutions, do not apply to banks. The specific requirements revolve around, here we go, this is the crux of it, 4 key areas: documentation, valuation, portfolio matters, and handling of disputes. And that's it. So we're told that, yeah, conduct requirements are such now that you've got to mitigate risk where you're involved in an OTC transaction for derivatives that's not centrally cleared, and the requirements revolve around documentation, valuation, portfolio matters, and handling of disputes. So there's not much to examine on that page except the 4 key areas, because there are 4. Classic question would be they give you 3 and they put in one that's incorrect and ask you which one's incorrect. That's the only way I could see them addressing those points. And then the second area under the conduct requirements, group affiliates and other connected persons. They're looking at risk management, dealings, and disclosure when dealing with unlicensed person. And it's the last part and the last bullet point and the last part that I'm going to highlight. Otherwise, I just don't see this being covered much. Disclosures when dealing with unlicensed persons. And the last bullet tells us, in such cases, additional risk disclosure should be included in the written client agreements that bring to the attention of the client that the group affiliate is not licensed by the SFC, and that the regulatory oversight protection afforded to the client might not be the same as if the group affiliate were licensed and regulated by the SFC. So obviously that relates to when someone is dealing with a group affiliate where maybe part of the group is licensed, but the affiliate you're dealing with is not licensed, and there should be additional risk disclosure in the written client agreement. The other material, have a read through, but I wouldn't get too excited about. And then section 4 under topic 7, the most recent to be added with regard to over-the-counter derivative transactions, margin requirements for non-centrally cleared OTC derivative transactions. Now, what's happening here? Well, if it's non-centrally cleared, there is no clearing. So this is where mandatory clearing is not required. And we have the normal situation where you have 2 counterparties where default risk does exist. So now they're putting in requirements such that you're reducing this default risk by introducing the concept of margin. Now, I am going to read through most of this material because it's fairly detailed, but I will then highlight the most examinable points as I go through it. As we'll see, some of it is not yet operational, which means the chance of this being examined is very, very low, but you never know. An examiner might dig into something they think is relevant. So with regard to the introduction, as part of the post-2008 financial crisis reform to the OTC derivative market, we've covered this already, minimum standards for margin requirements for non-centrally cleared OTC derivatives have been established jointly by the Bank of International Settlement, IOSCO, International Organization of Securities Commissions. So this is big picture. This is international. Objectives of the requirement are to reduce systemic risk and promote central clearing. What that's saying is to prevent people from defaulting and there being major liquidity problems in the system. The Code of Conduct provides for the collection. So this is within the Code of Conduct as well. Section 3 was Code of Conduct, and this is an extension, but it's very specific to margin requirements. The Code of Conduct provides for the collection of initial margin and variation margin. Now, we have the concept of initial margin and maintenance margin with futures, so it's very similar. IM and VM, initial margin and variation margin, refer to collateral that has to be posted by one party to the other to protect the receiving party from the giving party defaulting. In other words, you're going to enter into an OTCD position, which you don't settle until the future, but you're going to pay good faith deposits through an initial margin so that if the other party does default, then you're covered. Initial margin reflects the potential future exposure at the time of entering into the OTCD transaction. So the exposure that exists now, you're going to cover in its entirety, whereas variation margin reflects the current exposure incurred as the mark-to-market value changes over time. So you put in collateral, you make a payment, the initial margin to the counterparty, and then if your position goes into loss and you have more exposure, you've got to top up the margin that you've paid the counterparty. Initial margin and variation margin are normally posted and collected by both parties, protecting each party from the possibility of default. Now that concept could be examined, and as we'll see, some of it's been introduced, but not all of it. Scope of application, subject to the requirements. Requirements apply to any licensed person who is a contracting party to a non-clearing over-the-counter transaction with a covered entity. I've got to find out what a covered entity is. They do not apply to registered institutions. So that's something I'd keep at the front of my mind because that's easy to examine, this concept of margin requirements for over-the-counter derivative positions. Covered entity, what is it? It refers to entities that during the 12-month period from 1st September to 31st August, well, that's the time period they've selected, following the following year is either a financial counterparty itself or with its group companies with an average aggregate notional amount of this derivative position exceeding 15 billion Hong Kong dollars. So we're talking about a lot of money, or a significant non-financial counterparty with an average aggregate notional amount of the OTC derivative position exceeding 60 billion. So 15 million Hong Kong dollars, 60 billion. I'd be surprised if they examine the monetary amounts. Now, a lot easier to examine. The following are specifically excluded from the definition of covered entity. So these parties do not have to consider posting margin. Governments, central banks, non-commercial government agencies, multilateral development banks specified by the Hong Kong Monetary Authority, and the Bank of International Settlement itself. It's putting forward the rules, but it doesn't have to play by them. I would remember that list, or I'd be aware of that list. You never know if a question pops up. That would be quite easy. Instruments subject to the requirements. So initial margin, variation margin requirements apply to all OTCD non-clearing transactions. However, they do not apply for certain physically settled foreign currency, Forex transactions, certain commodity forward transactions, certain currency contracts. Well, that's, I would say, by way of interest. I wouldn't be too concerned about it. Exceptions to the margin requirements. You don't have to put margin down in an over-the-counter derivative position. The margin requirements may not apply. 3 circumstances: where there is reasonable doubt about the enforceability of a netting agreement in respect of initial margin or variation margin, or collateral protection arrangements; intra-group transactions within a group of companies where risk is managed on a consolidated basis. Thirdly, the licensed person has notified the SFC that it will perform substituted compliance. Licensed person will adhere to margin requirements of another jurisdiction. Okay, in those 3 situations, you don't have to post margin to the other counterparty. What are the initial margin requirements? The initial margin must be exchanged where both licensed person and the counterparty have an average aggregate notional amount in excess of 375 billion Hong Kong dollars. We're told it's going to go down to 60 billion from 1st September 2022. So as I say, this is going to change over time. Initial margin does not need to be exchanged where the licensed person has no counterparty risk, or where the counterparty is a significant non-financial counterparty using derivatives for hedging purposes. Okay. Initial margin does not need to be collected where the amount due is 375 million or less. Well, that's just the flip side of the first bullet point. Initial margin received by a licensed person should be protected by using a third-party custodian and should be treated as client assets. Okay, so when you receive the initial margin from your counterparty, when you've entered into a derivative transaction, you don't keep the money yourself. It should be kept by a third-party custodian, usually a bank, and should be treated as client assets. That's very specific. And we're told the initial margin requirements will start 1st September 2021. The variation margin requirements took effect from the 1st of September 2020. Variation margin requirements for the licensed person has an average aggregate notional amount of derivative position in excess of 15 billion. Variation margin must be exchanged for a 12-month period commencing 1st September. So this is the detail. I'd be surprised when they examine this, if they examine the detail. For certain Forex contracts, threshold 60 billion, okay. Calculation of variation margin should be subject to a single legally enforceable netting arrangement, all right. So you net off variation margin against initial margin or other variation margin. The licensed person may elect not to exchange variation margin with a significant non-financial counterparty using derivatives for hedging purposes. Okay, a lot of detail. Variation margin does not need to be collected where the amount due since the last exchange is equal to or less than 3.75 million Hong Kong dollars. That's 10% of the minimum amount. Where the amount is more than 3.75, the full amount needs to be exchanged. Variation margin should be calculated at least on a daily basis. I'd be aware of the concept of initial margin. That's what you pay when you set up the over-the-counter derivative position that you're not going to use central clearing. You set up an initial margin position with the counterparty. Each party pays the other. And then as the valuation of the derivative position changes over time, then one of the parties will have to top up by way of variation margin. I'd be aware of the big picture. I don't think I'd get into the detail of the numbers. And finally, paragraph 4.5, assets eligible as initial margin and variation margin. The assets that are accepted are cash, marketable debt securities, gold, and listed shares. Assets not acceptable: securities listed by a company in the same consolidated group as the licensed person, too close to home; securities significantly correlated with the counterparty's creditworthiness or the derivative position's value; and securities that are not of investment grade. Now, if I was writing an exam question, those are easy points to address. So just have that in your head with regard to initial margin and variation margin, what is accepted and what is not accepted as collateral. That brings us to the end of topic 7. The topic 7 is a strange one because normally it has the least number of questions of the whole exam, traditionally 1 question. But as I've explained, the material in topic 7 is growing because the regulation of over-the-counter derivative transactions is developing over time. And so it will become more and more prevalent in Hong Kong and quite possibly the exam. So I would read the material, I would do the questions, but then I would move on. I would spend more time, for example, topic 3 and topic 5, where you're going to get a very high return for time spent because there's more questions in those topics. As ever, best way to prepare yourself for topic 7 is to do the practice questions on Examinator.online.